My theme today, and I'm not going to go through all the slides, I'll show them, but I won't discuss all of them, is that the United States is economy is a real island of stability in a very volatile world. And this Financial Times cartoon sort of shows Mario Draghi on top, embarking on quantitative easing in Europe right now, and basically try to ignite the European economy, which has basically been in recession since 2008. They've had technically 3 recessions in parts of Europe in the past 6 years. And then on the far right, you have the Greek flag and Syriza, which is the new governing party of Greece. And there's all kinds of headlines saying that the Greek problem was solved. Well, the Greek problem was solved in principle, but it has not yet to be solved in practice. And the Greeks have yet to deliver a formal proposal to the European Commission as to exactly and specifically and concretely what they're going to do to solve their problems so credit can be extended from the rest of Europe into Greece. So that could blow up again. That in part could be one of the reasons why the euro is at 106 today. It was 120 at the start of the year. It was 130 a year ago. So we're in the middle of a currency war with Europe right now. So Europe is very wobbly. And the other thing is when you heard BRICS, they were going to run the world, Brazil, Russia, India, and China. Well, Brazil is in the tank right now. Russia is in recession, is going into deeper recession. In China, nobody really knows. They just make up the numbers, so you really don't know what's going on in China. But the Chinese economy is weak, so the only thing working is India of the 4 BRICS. That were basically going to power the global economy. So the United States looks pretty good in this world. So our theme is we're going to grow around 3% a year, not quite in the first quarter, but thereafter. The unemployment rate is going to hit 5% by the end of the year, maybe sooner. Despite the very strong dollar and very low interest rates abroad, we think the Fed's going to go. And I could be tested on this thing next week because the Fed has their meeting, and in our opinion, they'll take out the word patience because everybody, like ancient Talmudic scholars, read every word that the Fed says. They take out the word patience. It means the go-ahead to raise rates in June. It doesn't mean they will, but they give the go-ahead. If they leave the word patience in, our forecast of a June rate hike by the Fed will not be valid. So we'll know in a week whether this forecast has a chance or not. Next thing is Walmart, we think, rang the bell as to with wage increases, and I think we're going to be in an environment where wages, instead of growing around 2.5% a year, will probably be growing around 4% a year. And we don't underestimate what Walmart did. A bunch of other retailers have since also moved, saying they were going to raise their lowest wage for their staffs. So and also the job openings report that the Census Bureau puts out. Said most job openings in 15 years. A lot of people are quitting their jobs and to find new jobs. The quit rate is going up, so there's all kinds of anecdotal evidence suggesting that the labor market's getting a lot better. I think with higher wages and a modest rebound in oil prices, we're going to have 2+% inflation. And then finally is after lowering estimates on housing for the past 3 or 4 years, this is the first forecast in a while where we're raising the estimate for housing starts, not by a lot, but raising it both this year and next year. And there's all kinds of anecdotal evidence coming from builders that traffic at new projects are going great. New sales at new projects are going great. And also the lower gasoline prices will help single-family building in fringe areas because it takes one of the big uncertainties of how am I going to commute from Riverside into Los Angeles or something like that. That gas isn't going back to $5 for a long time. All right, so here's the GDP forecast. We basically have 3% for 2 years. We have things slowing down in 2017 as interest rates will be somewhat higher. Will be at full employment. The Fed will be trying to respond to a small inflation, and capital spending will sort of run its course. So we have some kind of a slowdown in 2017, but that's 3 years away, 3 years away. We're not worried about that now, but we just want to put that out on the forecast. It's our first crack at 2017, but this year and next year is fine. This is the employment growth. All you need is a ruler for this and then bend it at the end, and that's the simple forecast. This is the unemployment rate. We have it dropping to 5% by the end of the year and staying there. That's our guess for full employment. It could be better than that. It could get to 4.5 where we were in 2007. That's not out of the question. We're sort of plateauing it around 5%. Okay, here's the dollar. Now, this was put together at the end of February. The dollar's much stronger than this. The dollar's just been straight up. It's on a tear against the euro. It's on a tear against the Japanese yen. It's on a tear against a lot of the emerging market countries. It's on a tear against the Canadian loonie. Canada was parity about a year ago. The Canadian dollar is 78 cents right now. So Vancouver's a good vacation spot right now at 78 cents. What this will do is it will make our exports more expensive. It will make our imports cheaper, so it will affect our trade balance. But here, take a look at how the U.S. is doing. Just look at the 2015. We have the U.S. at 3.3%, 2015 over 2014. Double the Eurozone, which is 1.5, triple Japan, which is 1.1. So the United States, we're doing great compared to the rest of the world. It's not as fast as it should be, but compared to the rest of the world, we're in great shape. Part of the reason why the dollar is so strong. China, we have at 7.1. The government put out their new numbers at 7.0. China is the only country where they tell you what the GDP is before the year is out, and they hit the number. So nobody really knows. I mean, yeah, they do not have double entry bookkeeping with their GDP accounts. So whatever the government puts out a number, and people on Wall Street sort of guess what they're going to say, but it has nothing to do with what the real economy is. So I just put that out. They have a 7% number. Their number a few years ago was 11%. So it is, for them, it's quite a slowdown. Okay. Now, the other thing going on in the world, which adds risk to our forecast, is we have negative interest rates in a bunch of places. The German rates are for two-year money is negative 22. Overnight money is negative 50 basis points, which means you are paying to put money in the bank. They're charging you to have a deposit. Okay, that's what's going on. Switzerland, it's minus 1.115. Negative rate in Switzerland for two-year money. 10-year Swissies are just 3 basis points. 5-year is minus 0.45. Nestle's, the chocolate company, is borrowing money at negative rates. And you sort of scratch your head. Well, why don't you just turn them, why do you have it at negative rates? Why don't you just hold it in currency? Well, I don't know, it's hard to store $1 billion or $100 million or $10 million. And the biggest denomination bill is the 500 euro note. So you have to have guards, you have to have safes, you have all kinds of things. And you got to take a wheelbarrow to pay somebody. You can't just write a check against currency. So whatever economists said about a zero bound for the lowest rates could be a zero, that's wrong. There's no economics textbook that's been out there that talks about these kind of negative rates. So we really don't, we're in an uncharted world, so that's risk to the forecast. It's also risk to our saying that rates could rise, say from 2% to 4% on the 10-year Treasury when rates are so low in the rest of the world. The German 10-year today, by the way, was trading at 0.18 for a while today. So Germany borrowing money at, and you want to say, well, it's only Germany. Well, Ireland, which was bankrupt 3 years ago, the luck of the Irish is they're borrowing at 75 basis points for 10 years. Okay, that's weak export growth. Import growths pick up. Here's our Fed funds forecast. We're having them raising every other meeting starting in June. So we end the year, we're at 0 right now, we'll be 25 in June, 75 basis points in December, something like that. So that is my analogy is the Fed has the pedal to the metal. They're going as fast as they can, and what they're doing is they're going to lift their little toe off the gas pedal. Policy will still be very stimulative, even at 75 basis points at the end of the year. So we don't think it's going to affect the economy. It's a sign that things are getting better, in fact. All right, here we have inflation is now negative because of gas prices. We think inflation is going to pick up as gas prices level, as oil prices level off and then begin to grow a little bit. And then we'll have wages running through the cost of living, and we also have rents putting upward pressure on the core CPI. So we could see inflation above 2% within a year. Okay, and this is wages, this is total compensation. Part of it swings around because of health benefits due to Obamacare, but our sense is we're going to be above 4% starting by the end of 2015 into 2016, and we'll begin to see some real gains in wages. Okay, this is the price of oil. Oil today is $49. We have it going on a quarterly average, going as low as $42 next quarter. So we haven't seen the bottom in the price of oil in our view, but we're not good at forecasting the price of oil. We have it ending the year at 60. The marginal cost for fracking right now is $70 a barrel, but it's still, all that oil is coming on. In January was a record month for United States oil production. We think ultimately, with the rig count collapsing, ultimately we'll have, supply will get reduced and the prices will go up, and the Saudis ultimately will cut back on production. That's the call here. That's part of what gets the inflation rate back up again. All right, energy capital spending, 140 billion, going to 90 billion, 95 billion real fast. Energy capital spending, which is basically investment in new oil wells and undersea oil wells and fracking, and some related facilities on land, is bigger than commercial construction. Commercial construction is a $100 billion industry. Energy capital spending is a $140 billion industry on its way back down to $100 billion. So this is a big industry. This is one of the near-term negatives on the economy. Consumer should do fine. Retail sales number was a poor number today. It was a poor number last month. So where's all this low gas prices being spent? And we sort of scratch our heads as economists. We don't know. Some of it may be in health services and other kinds of services, maybe in travel. But the one business that seems to be doing great are restaurants and bars, so that's a sign the world is getting better. And that was up 11% year over year last month. Housing, we have housing on the road getting better, and we have housing at $1,250,000 for this year and over $1 million for next year. So we think housing will begin to rebound reasonably well. And we're also, since we're in the Kirk Douglas Theater, we have the award for the best screenplay to Vladimir Putin for his orchestration and writing of the ceasefire in the Ukraine. This is a work of fiction. This is not a work of, this is not a documentary. And because of that is we think real defense spending, given what's going on in the Middle East with ISIS, ISIL, whatever you want to call them, and what's going on in the Ukraine is we think sequester will be over, and we think we'll see more defense spending after 4 years of declines. We think this year, next year, and the year after, we'll have some modest increases in real defense spending to recognize what's going on in the world. Stay tuned for this. The congressional committees are meeting on this, and we'll find out pretty soon. So that's sort of where it is. It's an upbeat story. I think we could do 3%. The labor market is strengthening. Unemployment is falling. Wages are rising. This is all good. We'll have an uptick in inflation. In response to this good news, the Fed, because the economy is getting better, will raise rates. It's not going to slow anything down. And I think it also is with rates backing up a little bit, I think this time with rates backing up, people says, I got to buy the house now because rates may be a little higher in the future. So I think housing surprises on the upside. So all in all, I think it's not a great story, but compared to the last 4 or 5 years, it's really a pretty good story. Thank you very much.